Good afternoon, everyone. As Paul mentioned, over the next few minutes, I'm just going to firstly take us through tax residency. And many might say, well, why is it important for employers to understand an individual's tax residency status? Well, it is becoming critical. Tax residency of an employee is important for an employer to understand, as it can impact the employer's tax reporting and withholding tax obligations. So an employer does need to, or an Australian company does need to understand the tax residency status of their employee, as it will affect potentially what their pay-as-you-go reporting and withholding obligations are, whether there's any SG, mandatory obligations, FBT, as well as payroll tax. So in terms of, at a high level, what are the Australian tax residency rules? So just as a really high level concept, we have 4 key tests here in Australia around determining tax residency. The primary test is the ordinarily resides test. And we also have 3 statutory tests: the domicile test, the 183-day test, and the Commonwealth Super Fund test. So if the Commissioner deems that an employee or a taxpayer is a tax resident under any one of those 4 tests, then they are a tax resident of Australia. It's also important to note that simply being present in Australia for under 183 days does not automatically mean that someone is a non-resident of Australia for tax purposes. So the 2 key things that Australian companies need to be aware of is firstly around tax residency. The second key factor that they need to understand is source of income. And we'll come to why source of income is becoming more of a critical issue. But where an individual is deemed to be a tax resident of Australia, they will be taxed on worldwide income. So whether that individual is performing services here in Australia or performing services outside of Australia, that salary will generally be taxable here in Australia. Where an individual is deemed to be a non-resident of Australia for tax purposes, that individual is only taxed on Australian sourced income. So this table really just demonstrates the differences for an individual being a tax resident versus a non-resident. And as you can see, that where they are a resident, a number of thresholds, offsets, and levies can still apply to that particular individual employee. Now, why is residency and source of income becoming more and more important? Many people would appreciate that there has been a large increase in remote flexible working arrangements, as well as changes in international working arrangements, particularly post-COVID. And the question of tax residency has become increasingly relevant and contentious. So the ATO recently issued Taxation Ruling 2023-1, which really looked to modernise the previous tax rulings which were issued in the 1990s. Now, TR 2023-1 includes 14 modern examples of different working arrangements that really do help provide an understanding of what the ATO's current view is on the individual tax residency rules. So whilst this TR 2023-1 is not a change of law, it really just sets out the ATO's interpretation of the existing rules. The key takeaway is the devil is still in the detail, and it will be in the relevant to understand the individual's facts and circumstances. So whilst the 14 examples do provide common scenarios that we often see, it is important to understand the facts and circumstances of every particular case, because they do vary from person to person. Now, TR 2023-1 does highlight that the key factors still apply in determining the ordinarily resides test. And some of those key factors look at the period of physical presence in Australia and overseas, the intention or the purpose of the presence in each jurisdiction, the behaviour of that individual whilst they're in Australia. It looks at where their family are located. Do they have business interests in Australia or employment ties in Australia, or are they overseas, as well as maintenance and location of assets and social connections. So as I mentioned, this ruling does look to replace and consolidate 2 previous tax rulings that outline 2 key previous rulings, and they were TR 9817 and IT 2650. As I mentioned earlier, they do not change the existing residency rules. It really just reframes the Commissioner's view on those existing rules. Now, many people might be aware that in the 2021 federal budget, the previous government did announce proposed changes to the tax residency rules, and it was looking at the introduction of a bright line test. Late last year, there was a consultation period. At this stage, we're still unsure whether the current government is looking to move forward with the previous government's proposed changes. So at this stage, it's still a wait and see. But more importantly, in recent times, we have seen certain ATO decisions, as well as some decisions from the tribunal, where the ATO is taking a firmer stance on certain tax residency scenarios. In particular, where a taxpayer does maintain some connection with Australia or has limited connections in that overseas country. In a lot of situations, the ATO are looking to determine that that individual could still be a tax resident of Australia. So as I mentioned, tax residency is really important. That second key aspect is really looking at, well, what is the source of income? So if we have someone that either remains a tax resident and is taxed on income from worldwide sources, or moves abroad and becomes a non-resident of Australia, then understanding source of income is important to determine whether there is an ongoing obligation here in Australia. Now, we are seeing more and more employee-driven requests. We do field these questions from clients nearly every week or every few weeks around another employee approaching their company to say, I want to look to work remotely abroad, whether it be for a short, medium, or long-term period. So prior to that organization approving that remote working arrangement, assuming that that role can be performed overseas, it's important that the company understand firstly the tax residency status of that employee, but also around what's the source of that remuneration going to be when that individual starts working abroad. More importantly, in recent time, we've seen some private binding ruling decisions from the ATO that have taken a shift in their approach in determining source, which is really out of step with the OECD norms. So historically, the ATO's position, whilst there are key factors that we look at in determining source, one of the key factors is where is the individual physically performing those services. So where we have a situation where an individual moves overseas, it could be for a remote working arrangement, and that individual ceases being a tax resident of Australia, as long as they are performing their services physically in another location, typically those salary and wages would be considered foreign sourced income and would not be taxable here in Australia. Now, the ATO had previously applied the principles of the French case. This case dates back to the 1950s, but really looked at key factors that would be considered in determining source, and that looked at the circumstances of the employment contract or where the employment contract took place, looked at where the services were being performed, also looked at the process of obtaining payments. So really, where was the payroll being processed? Which bank account was the funds being deposited into? Now, in line with the OECD tax model, the ATO typically recognised the most important factor was where was the location of the work being performed in determining source. However, more recently, and what we've seen in a couple of private binding ruling decisions. Now, whilst those private binding ruling decisions are only binding on those organisations that they relate to, it does give us an understanding of the shift in the ATO view and seeing that the ATO is putting greater emphasis on the location in which the work is given effect to and where the outcome of the work occurs, rather than the location in which the work was performed. So whilst these private binding rulings may indicate a shift in the ATO approach, the reasoning applied is not binding, and it is still reasonably likely that the income derived by the individual in cases where we've got remote working arrangements could still be considered foreign sourced income. So this slide really just takes us through a really simple example, really around, if we've got an individual employed by an Australian business, the employer relocates overseas. So let's say the individual, for family reasons, goes back. Maybe they were a New Zealand citizen originally, moves back to New Zealand for family reasons, but continues to perform their role for the Australian company. And in this situation, the individual becomes a non-resident of Australia for tax purposes. Previously, where the individuals are non-resident of Australia, they would only be assessed on Australian sourced income. And although the jurisdiction of the employment contract was Australia, assuming that they're physically performing that role in New Zealand, that income would have been New Zealand sourced employment income, and there'd be no reporting, withholding, or tax obligations here in Australia. However, based on these recent ATO private binding rulings, there is a shift into looking at more where are the benefits of the outcome of the work that's being performed. And there is a risk that in these scenarios that the ATO may deem that this is Australian sourced income. Now, if not understood or structured correctly by the company when agreeing with this individual to work remotely, there can be scenarios where we actually have double tax applied. Because in this scenario, it is likely that the New Zealand tax authorities would deem that income New Zealand sourced, the ATO are deeming it Australian sourced, and we would need to look at the double tax agreement to see whether there is any relief from double taxation. More importantly, if that situation was with a country that we do not have a double tax agreement, then there'd be less ability to try and provide relief from double taxation. So there can certainly be risks of double taxation in certain remote working arrangements. Now, the last section I'm going to take us through today is employee share schemes. Now, employee share and option schemes have been growing in popularity over the last few years, particularly in the technology and startup sectors that we're seeing. They are being offered to by both listed and unlisted companies, and really used to help incentivize, retain, and attract key talent. We are still seeing a war on talent by employers, and many organizations trying to either attract key talent or looking to, whether it's motivate, incentivize, or retain key staff. And employee share schemes are still quite can still commercially help organizations meet those objectives. There's a lot of different types of forms of employee share schemes out there, and this slide really just highlights some types of alternatives that organizations do consider. So you've got the more traditional employee share schemes, you've got employee rights schemes or stock option schemes. You have schemes that qualify for the startup concessions, and we'll spend a few slides going into this through the startup concessions. You've also got the $1,000 employee share scheme, which is a share scheme that provides certain tax concessions to employees up to $1,000, where certain conditions are met. We've also got company-funded employee share loan plans. So there's a variety of different schemes that can work for some organizations depending on what they're trying to achieve. So I mentioned earlier around the employee share scheme startup concessions. Now these concessions were introduced in July 2015. They are very attractive to participants. They also provide certain tax concessions for employers. The first thing that you need to do is determine, firstly, are you a startup company? And you can see there on the slide that it lists what the conditions are. So really you need to be unlisted, you need to be an Australian company. All companies within your group must have been incorporated for less than 10 years, and you must have an aggregated turnover of less than 50 million or not exceeding 50 million in the year before the grant of the equity award. So if we tick through those conditions and the company is considered an a startup company, then depending on whether you want to issue shares or options, there is further conditions that need to be satisfied. So if you're looking to issue shares to employees, then if you want to take advantage of the startup concessions, the discount on the issue of shares to employees can be no greater than 15% of fair market value. Immediately after issue of the shares, the employee cannot hold a beneficial interest in more than 10% of the company. And there is also a minimum holding period requirement of 3 years, unless termination of employment under specific scenarios. So if you're issuing shares and you satisfy those 3 conditions, then the plan will be considered a qualifying employee share scheme under the startup concessions. If you're looking to grant stock options under the startup rules, then the key criteria is that the exercise price needs to be at least equal to fair market value of the underlying shares on date of grant. So effectively, the stock options could not be in the money on day one. Similar to the share plan, we also have the 10% ownership and voting rights test, as well as the rights or the underlying shares need to satisfy the minimum holding period of at least 3 years. So where a company introduces a startup plan and it does meet all the conditions, then the tax benefit for the employee is that there is no income tax at date of grant, there is no income tax at date of vest of the right, there is no income tax at the date of exercise of the right or option. The taxing point is effectively deferred for the employee until they sell the underlying share, which could be 10, 15, 20 years down the track. The other significant benefit is rather than being assessed on the revenue account, which traditional share and option plans are, it is assessed on capital. And therefore, assuming that the individual has held the right or the share for at least 12 months and they are a tax resident of Australia, then they would be eligible for the 50% capital gains tax discount. So, significant benefit for the employee in that we are deferring the taxing point to well down the track, as well as we are effectively halving the tax rate by being on capital. A significant benefit for the employer is that in terms of valuing the underlying share, they can use an ATO approved safe harbor method, which is effectively the net tangible asset position of the company. Now, Paul mentioned earlier around employee share scheme reporting obligations and how a lot of the state revenues are using that to ensure that companies are declaring that correctly for payroll tax purposes. It is important that organizations are aware that they do have these reporting obligations. Unfortunately, we are still seeing some organizations not being fully across the reporting obligations. Typically, this is the case where it's an Australian subsidiary and it's an overseas parent company that are managing the global plan. It might be that the share-based team sits outside of Australia and possibly are not providing relevant information to the finance or tax team here in Australia. But if you do have employees that are participating in a global plan or just a domestic plan, there are key deadlines. Employee share scheme statements do need to be issued to employees by the 14th of July. There are reporting obligations to the ATO by the 14th of August after the relevant reporting date. It's important to note that we do have employee share scheme reporting software. So if you find that you are unable to meet your reporting obligations, that we can also assist with ATO approved software. As Paul mentioned earlier as well, the other area that we are seeing some organizations not being aware of is that employee share scheme awards is generally needs to be considered for payroll tax purposes, as it does fall under the definition of taxable wages. There are alternatives for payroll tax, and organizations can choose to either pay payroll tax at date of grant or at a deferred point. So upon the implementation of employee share scheme, it's important to understand the pros and cons of either paying payroll tax at grant or deferring it to a later point in time. My final slide is really just around being aware that there were some corporations law changes in October 2022. There was the insertion of Division 1A into the Corporations Act that replaced two ASIC orders that were originally in place. This really were introduced to make it easier for listed and unlisted entities to obtain regulatory relief. So if you are an organization that is thinking of putting an employee share scheme in place, it's important to be across these and understand if there are any disclosure requirements that you need to be aware of, or whether there's any exemptions or relief under this new division.